Welcome to Lithium-ion Rocks, a podcast co-hosted by Lithium-ion Bull Howard Klein at Howard Klein 10 and Rodney Hooper at Rodney Hooper 13. Broadcasting from Bull's Lair, Forest Hills, Queens, New York, the hometown of the legendary Paul Simon. And from South Africa, which Simon helped popularize in the 1980s with his Grammy-winning Graceland. And where Iron Man Elon Musk had a brutal childhood before moving to Canada as a teenager with only a backpack full of books. Rodney and I have decided to broaden our contributions to the social media ecosphere with the second, but not the second best, podcast focused exclusively on the lithium-ion battery materials chain. We couldn't wait for gear enabling direct conversation from two locations to arrive in time, so this first podcast may sound more like an audiobook from a carefully written script conveying Lithium-ion Rocks' raison d'etre. Future episodes will have guest interviews and audience Q&A. Lithium-ion Rocks is targeting born in the USA, Jane and Joe battery pack, sophisticated Gen Xennials, thoughtful, self-directed, active investors, Tesla shareholders and Model 3, S, or X owners, or those aspiring to own, interested in rapid growth thematics, and picking individual stocks, including early-stage microcaps. Those who understand that lithium fuels Tesla, and lithium fuels Mary Barra's GM and her all-electric future, and that lithium fuels Ford and VW's global alliance. Lithium-ion Rocks also expects to have a substantial audience in Australia, Europe, Canada, and elsewhere. Rodney and I already have large followings amongst sophisticated equity funds, family offices, sell-side analysts, C-suite lithium executives, but not so much mutant ninja lovers. Rodney, does the investment world really need another lithium materials-focused podcast?
Yes, Howard, I think it does. The pioneering Global Lithium podcast, The Best, the Worst, the First, has done a fantastic job of educating listeners about the industry. We believe the public discourse could be enhanced further with a greater focus on investment opportunities, with fundamental company analysis. We plan to get to the bottom of company financial and ownership structures, and to discuss the risks and potential rewards of investing in specific names. Who has cash on the balance sheet? Who doesn't? If a project is fully funded, how leveraged is it? There are also glaring discrepancies of estimated capex per tonne of installed capacity between projects located in Western Australia. Could there be unavoidable capital raises for those that have underestimated their capex costs? After 2018's extreme focus on supply, we believe 2019 will be a year in which demand comes in to sharper relief, and are interested in hearing views on growth directly from end users.
Thanks for that, Rodney. And I agree. Joe's large canon of the written and spoken lithium word has been a great help to us all. And Jane Battery Pack Emily Hirsch's voice offers a great balance of prescient insights, questioning, and a sense of humor, which sets a very high bar for the Lithium-ion Rocks to emulate. I'd like to take this opportunity to suggest all listeners to Lithium-ion Rocks to visit our website, www.libull.com, which will host these podcasts and all prior issues of the Lithium-ion Bull. Also, if you're not already a direct subscriber to the Lithium-ion Bull, please enter your email at the site. And feel free to forward to all your friends. Rodney's written some insightful posts on LinkedIn, including a January 2nd note entitled The Lithium Conundrum to Continue in 2019. He and I connected last September after his summer posts of overweight and underweights across a similar 10 to 30 stock short and long list that I've been tracking as the representative lithium investment. Comparing notes on SQM, Mineral Resources, and Piedmont Lithium, we found many commonalities in our thinking, and some differences on other names. It's now January 15th, and Mr. Lithium market has clocked 9 trading days since December's breakdown. More green than red, but a lot of sideways. I did a fair bit of tax loss selling to offset some early last year profit-taking, and I'm sure I'm not alone. In what should be a regular feature at Lithium-ion Rocks, Rodney and I will examine closely what information can be gleaned from the Mr. Market scoreboard, alongside some top-down analysis to ensure we don't lose sight of the forest from the trees. But first, we'd like to get a disclaimer out of the way. In Lithium-ion Rocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other lithium-ion rocks or lithium-ion bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.
I ain't talking about rich, I'm talking about wealth.
Most lithium equities have started 2019 at or near their 52-week lows. Lithium chemical prices have trended downward. The China ex-works prices for carbonate have plummeted in the past 12 months, but represent a very small percentage of the overall market. Demand remains robust, and suppliers are securing term contracts for most of their production. In my opinion, 2019 is make or break for lithium. Another down year for lithium shares, and a lot of investors may leave the space for good. When asked what the secret to making a small fortune in 2018 was, I replied, "That's easy. You just needed to start with a large fortune and then buy lithium shares." The bottom line is that the smart money was short lithium shares in 2018, despite contract prices for certain companies rising. Optically, lithium equity shares look cheap at the moment, but execution is key, and there are risks like falling spodumene concentrate 6 prices that could mean further pain in technical grade lithium carbonate prices and beyond that. Fast markets and others, while long-term bullish, are warning of short to mid-term price pressures. I don't think that these can be easily dismissed. They need to be discussed. We could also find ourselves in a position where the oversupply narrative is correct for spodumene concentrate 6%, but not for battery quality material needed for higher spec applications like EV batteries. Ultimately, lithium is still a small market, and small additions and subtractions in supply demand can have outsized effect on pricing. This will change when the market reaches levels like 1 million tons per annum, hopefully by 2025, when a 10 to 15,000 ton addition or subtraction is inconsequential. In my opinion, based on Chilean export data, thanks to Alejandro Hess, SQM's Q4 average price is likely to be 3 to 4% below Q3. In addition, production is likely to come in between 40 to 42,000 tons for the year, below the recent company guidance of 45,000 tons. Whilst the price fall will be nowhere near Orocobra's numbers, what will the impact of that be on the market? Is the price shortfall and the volume shortfall already priced in? Companies that produce battery quality carbonate or hydroxide and sell into the European, US, and Asian ex-China markets are likely to fare best from a price and price volatility perspective. What chemical quality is considered acceptable or unacceptable in Chinese batteries is still an unknown in my mind. We know from GM's experience that in certain instances, standards in China are likely well below those in South Korea and Japan. In addition to market demand growth, the diversification of battery manufacturers away from China will also result in exposure to more flexible credit and liquidity policies. Chinese companies often face a restrictive credit environment, resulting in them selling rather than holding their inventories. Albemarle at Wodgina should not have that problem, and Howard and I agree that it's possible they could become the swing supply in spodumene. Diversification by majors has been very significant in 2018. Not just brine versus hard rock, but Ganfen's done exceptionally well to secure new feed from Altura, while increasing its offtake from Pilbara and strengthening its economic interest at Mount Marion since they finalized their Hong Kong listing. Recent share price movements highlight the risk of spodumene concentrate-only projects, and also the risk of being a converter only without cheap feedstock in a declining chemical spot market. Vertical integration is key. As investors in individual lithium equities, we need to assess risk closely to avoid losses. And at the end of the day, regardless of whether broker research and the oversupply narrative is incorrect, we need to be cognizant that share performance and returns matter, both in the near and medium term, not just the long term. The majors and downstream end users will continue to execute deals with what we call the best of the rest deposits. They need, inverted commas, near-term production to meet growing demand and don't have 10 years to develop greenfield projects. Western Australia has the greatest potential to deliver new mid-sized hard rock projects with vertical integration upside. Brown deposits effectively meet the vertical integration criteria for carbonate. They also offer chloride as upside should solid-state batteries take off. But browns come with technical, environmental, and geopolitical risks that must be considered. One thing to watch is compliance with offtake contract pricing terms. In cobalt in the Congo, GEM effectively reneged on its term contract with Glencore, something we witnessed in iron ore and coal a number of years back. For now, this is unlikely to happen to lithium chemicals, but it is something worth noting and could happen in the spodumene market.
Thanks, Rodney. The immediate term still looks a bit choppy. Nomura just downgraded ALB and LTHM today. But I still have no doubt the long-term lithium outlook is very favorable, and those analysts writing lithium short stories that chemical prices will fall below 8,000 will be proven wrong, in my opinion. As I wrote when I indigested the Tangshi Red herring, however, Morgan Stanley and other air supply cover artists who have relied principally on SQM fear-mongering have done a poor job alarming Mr. Market with more justified Tangshi Albemarle Greenbush's paranoia. Together with Pilgangoora and additional Mount Marion volumes, Mount Catlin, Bald Hill, and now AMG's Mibra, a lot of spodumene supply is being produced, which is having an impact on spodumene prices. I've observed Chris Reed of Neo Metals to be a relatively astute market timer and gleaned some data points about spodumene from his selling the remaining 14% stake in Mount Marion. 2019, and perhaps longer, will likely see a hard rock balance of power shift back from the miners to the converters. But I don't believe egregiously so. Both sides need each other, so there's incentive to ensure strong margins and cash flows for all parties. How strong and for what time period is to be seen. Quarterly filings in February should be illuminating. Since the second half of 2018, Mr. Lithium Market has experienced long periods without detailed price guidance previously provided by new producers. Offtake agreements vary from company to company and offtaker to offtaker. A mating season is underway to haggle price out. Alliance Tuana traded only 2 days out of the last 30 since their merger amidst questions about whether their offtake partner Burwell will pay $880 if the market has moved below this figure. Last night, Alliance announced an amended offtake agreement with Jiangxi and Burwell with a pricing mechanism linked to, quote, carbonate and hydroxide prices in 2019 with, quote, price for each of the years 2020 to 2022 to be set by a formula with reference to market prices for comparable spodumene. I am interested to learn what comparable spodumene means. Alliance CEO Mark Calderwood inserted the words premium quality ahead of Bald Hill's spodumene concentrate 6%. This is relevant as it appears that a wide iron ore-like quality price differential may be emerging in the spodumene space. 5.5% doesn't seem to cut the mustard. Anything below 5.7% grade may suffer steep discounts, perhaps below $600. But 6% plus with low impurities may fetch $800 or more per ton. Note Altura and Pilbara's emphasis on 6.1% plus with low iron and mica content. I'm feeling more comfortable today than I did yesterday about Alliance's pricing, which seems at the very least to be in the 700s over the course of this year. Again, their partner Jiangxi has a vested interest in Bald Hill's success. What Alliance's cash cost and profitability will be is the big question. With a 5-year time horizon, to finance a kid's college, say, or 15 years to finance a reasonable retirement, I strongly believe that for a Jane and Joe battery pack investor, it is hard to go wrong owning what is today, what has always been, and likely always will be, the lithium oligopoly. Livent and Ganfeng are my favorites. Tangxi is uninvestable to most non-Chinese investors on Shenzhen. I just don't feel personally aligned with the anointed China SOE Tangxi progressing toward what looks to be the Chinationalization of Eduardo Bertrand and the Chilean People's Lithium. So even if they list on Hong Kong, I'd still avoid the share unless it gets crazy cheap. Albemarle and SQM both have significant positive attributes and meaningfully negative ones.